Corporate Finance Essentials, Decisions and Strategies. Welcome to our channel, where we explore the intricate world of corporate finance, unraveling the art of strategic decisions in capital budgeting, financing sources, and dividend policies. Corporate finance is a critical aspect of business management that revolves around the strategic planning, analysis, and execution of financial decisions to maximize shareholder value and ensure the long-term sustainability of a company. This field encompasses various key components, including capital budgeting, financing sources, and dividend policies. Let's delve into each of these areas in detail. Before we begin, make sure to smash that like button and hit the subscribe for more exciting content. 1. Capital budgeting. Capital budgeting is a fundamental process in corporate finance that involves evaluating and selecting investment projects with the goal of allocating limited resources to projects that yield the highest returns and create long-term value for a company. This process encompasses meticulous analysis, strategic decision-making, and a comprehensive understanding of the company's goals and risk tolerance. At its core, capital budgeting is about assessing the feasibility and potential profitability of investment opportunities. Several techniques are commonly employed in this process. Net present value. NPV calculates the present value of future cash flows from a project, accounting for the cost of capital. If the NPV is positive, the project is usually considered financially viable and capable of adding value to the company. Internal rate of return, IRR. IRR is the discount rate at which the NPV of a project becomes zero. Projects with IRRs higher than the company's cost of capital are typically favored. Payback period. This technique measures the time required for a project's cash flows to recover the initial investment. A shorter payback period is often preferred, as it reduces the risk associated with uncertain future cash flows. Profitability Index, PI. The PI is the ratio of the present value of future cash flows to the initial investment. A PI greater than 1 signifies a potentially attractive project. Modified Internal Rate of Return, MIRR. MIR addresses some limitations of IRR by assuming reinvestment of cash flows at a specified rate. Capital budgeting decisions have far-reaching implications for a company's growth trajectory and financial health. It involves assessing the risks associated with each investment opportunity, considering factors such as market trends, technological advancements, competitive landscape, and regulatory changes. The chosen projects should align with the company's overall strategy and its ability to generate positive cash flows over the project's lifespan. In conclusion, capital budgeting is a cornerstone of corporate finance that plays a pivotal role in shaping a company's future. By applying rigorous analysis and using appropriate evaluation techniques, companies can make informed decisions that drive growth, enhance profitability, and maximize shareholder value. 2. Financing sources. Financing sources in corporate finance refer to the means through which companies secure funds for their operations, expansion, and investments. This critical aspect of financial management involves a delicate balance between debt and equity to optimize a company's capital structure. Debt financing. This method involves raising funds by issuing bonds, loans, or other debt instruments. It offers the advantage of interest payments being tax-deductible, which can result in lower overall financing costs. However, excessive debt can lead to financial distress, impacting a company's creditworthiness and flexibility. Equity financing. Equity financing entails selling ownership stakes, shares, in the company to investors. While it doesn't involve regular interest payments, it dilutes ownership and can affect control. Moreover, shareholders expect a share of the company's profits in the form of dividends. Hybrid financing. Some financing options, such as convertible bonds, combine features of both debt and equity. Convertible bonds, for example, start as debt but can be converted into equity at a later date. Deciding the optimal mix of financing sources is crucial. It impacts a company's cost of capital, risk profile, and potential returns. The goal is to strike a balance between debt and equity that minimizes the weighted average cost of capital while maintaining financial stability. Careful consideration of the company's industry norms, growth prospects, and risk tolerance guides the choice between these financing sources, ultimately shaping the company's financial structure and its ability to pursue growth opportunities. 3. Dividend policies. Dividend policies in the realm of corporate finance revolve around the strategic decisions that companies make regarding the distribution of profits to their shareholders. This aspect of financial management carries significant implications for a company's financial health, investor perceptions, and access to capital markets. Dividend relevance. This theory, proposed by Modigliani and Miller, suggests that a company's dividend policy does not affect its overall value. It posits that investors can create their desired cash flows by selling shares if dividends are not aligned with their preferences. Dividend relevance. While some investors value receiving dividends as a sign of a company's stability and growth potential, others focus on capital gains. Dividend policy can influence investor sentiment and stock prices. Dividend stability. Companies that adopt a stable dividend policy aim to provide a consistent dividend per share over time, regardless of fluctuations in earnings. This strategy can attract income-oriented investors seeking predictable returns. Residual dividend policy. This approach prioritizes funding profitable investment opportunities before distributing dividends. Remaining earnings are then paid out as dividends. It ensures that the company invests in projects with the highest potential returns. Dividend growth policy. Companies with a growth-focused strategy gradually increase dividends over time. This policy is often linked to a company's earnings growth and can attract investors seeking increasing returns. Share repurchase. Instead of dividends, some companies buy back their own shares. This can increase earnings per share and enhance stock prices, benefiting shareholders. Choosing the right dividend policy requires considering factors such as the company's growth prospects, financial stability, and investor preferences. A balance must be struck between returning value to shareholders and retaining earnings for future growth and investment opportunities. The chosen policy reflects management's view on the company's ability to generate consistent earnings and deliver value to its shareholders over time. In conclusion, corporate finance involves intricate decision-making processes that impact a company's financial health, growth prospects, and shareholder value. Capital budgeting helps allocate resources to projects with the highest potential returns, while financing decisions involve determining the right mix of debt and equity to fund operations. Dividend policies shape how a company shares its profits with shareholders. By carefully navigating these areas, companies can achieve their financial goals and create long-term value for all stakeholders. If our videos prove valuable to you, be sure to express your support by sharing, subscribing, and giving the like button a solid click to help our channel grow.